business. This is your Forex market commentary brought to you by REAL ECN. Today's commentary, we will break down and explore the euro-dollar pair. A correction in the euro-dollar pair during last week's trading session was induced by a brief spike in volatility. However, investors are awaiting this week's US CPI print as well as the Eurozone PMI report to gauge whether this volatility can support a follow-through momentum. First, in line with this commentary, we will explore the euro-dollar pair on the technical front. After last Thursday's sell-off in the equity market, the euro-dollar followed by correcting from the mid 1.3600 down to the consolidative range at the 1.3500 level. On the daily chart, the price action of the euro-dollar pair indicate that the pair is trading slightly above the 38.2% Fibonacci expansion mark by the 1.3520 level. Failure to maintain trading momentum above this level will expose the pair to the next support tier set up at 50% expansion at 1.345. However, in the case that the bull can overpower the bear, the pair may retest the former support turn resistance set up at 23.6% at 1.358. In accordance to the SSI, which is commonly known as the Speculative Sentiment Index, there has been a shift in retail trader sentiment towards the euro-dollar pair. Last week's euro-dollar correction has seen retail traders pile onto long euro-dollar positions. Even retail open long and short positions after diverging in recent weeks have reversed course and fallen back into a tight convergent pattern. Usually, analysts would suggest taking a contrarian standpoint to this crowd sentiment. However, in a low volatility market environment, crowd sentiment can often prove right on the price action near reversal. Fundamentally, analysts would continue to remain bullish on the single currency under the circumstances that euro does not fall below the 1.3500 level and broader FX volatility does not pick up significantly. Analysis of a collection of technical indicators on the hourly time interval on the euro-dollar cross is suggestive of a temporary bullish market sentiment and recommend long position on the euro. The euro-dollar cross opened today's Sydney trading session 1 pip below the established Fibonacci resistance at 1.3525, while the Fibonacci support is set at 1.3521. Heading into this week's trading session, the euro-dollar market failed to maintain its bullish momentum as the pair had broke below the 200-day simple moving average during a correction last week. The significance of the 200-day simple moving average cannot be underestimated, as 200-day simple moving average contain more or less of 1 year's worth of trading data. Therefore, the long-term outlook on the euro-dollar pair has been downgraded to bearish if it continued to trade below the 200 days. This bearish standpoint is not validated on the short-term moving average front, as the pair opened today's Sydney trading session above the 510 in line with the 20 and below the 30 SMA, which is indicative of a buy recommendation on the simple moving average front. Moving along to the fundamental aspect of the euro-dollar pair, the S&P 500 VIX index is often employed by the market as a leading indicator to gauge the level of fear or volatility in the marketplace. Since the euro-dollar market is negatively correlated to a spike in volatility, the development in the VIX can help investors gauge potential breakout on the fundamental level. The correction in the euro-dollar market down to the 1.3500 level taking place during the month of July is reflective in the VIX index spiking. However, on the grander scheme, the VIX has continued to remain significantly lower than the degree of volatility seen during the 2008 financial crisis. Now, the golden question pending is how long will volatility remain muted? Since 2012, the euro-dollar pair had an extraordinary performance, rallying north of the 1.200 level to peaking out at 1.400 before correcting to the current price action of 1.3500. Much of the rally was funded by a large capital inflow into the Eurozone bonds and undervalued assets seeking higher return on their trade in the market environment where long-term volatility was on a decline. These enormous capital inflow into peripheral European bonds are highly leveraged with an adverse effect of suppressing the yield curve on these essentially risky assets. Therefore, moving forward, the euro-dollar pair will be placed in a position where it's highly sensitive to risk aversion, almost to the same magnitude as monetary policy changes. The trigger of a medium to long-term risk aversion can stem from this week's risk events. During Monday trading session, the euro-dollar pair corrected to the downside on a flat German PPI month-on-month print when expectations set at 0.1%. However, the IMF revised a growth forecast for the German economy from 1.6 to 1.7%. On Thursday, several Tier 1 leading economic indicators are out from Germany, with its manufacturing PMI expected to tick in at 52, while its service PMI is forecast to read at 54.5. Also, the Eurozone is expected to release its manufacturing PMI report, forecast to come in at 51.7 when the service PMI reading is expected to read at 52.7. As long as PMI reading does not dip below 50, implying a contraction, the euro-dollar pair will most likely remain supported in the short to medium term. Wrapping up this week trading session is Friday's German business expectation forecast to tick in at 104.5. The second major source of risk events stem from geopolitics. In the case that the EU may further pursue their sanction against Russia, this can adversely stall growth. The UK Prime Minister advocated freezing Russian assets and limiting business investment between the EU and Russia. Investors are not convinced that the EU can follow through with their sanction commitment, as the Eurozone is highly dependent on Russian oil import. Over in the United States, last Thursday's spike in equity volatility has given the greenback the momentum for a short-term bounce against all major currencies, including the euro. This week is full of Tier 1 leading economic indicators coming out from the US. On Tuesday, investors can anticipate the release of US core CPI month-on-month print expected to tick in at 0.2%, while core CPI year-on-year is forecast to grow by 2%. US CPI month-on-month is also expected to expand by 0.3%. As inflation is slowly beginning to show signs of gaining traction, the market is not convinced that it will be enough to force the Fed to hike rate anytime sooner. This is very reflective in the 10-year Treasury bond yield, which has continued to remain muted. Also on Tuesday, the US will release its existing home sale forecast to come in at 4.97 million. On Thursday, the US new home sale print is forecast to expand by 479,000, while its month-on-month report is expected to contract by 5.3%. Wrapping up this week trading session is Friday. US core durable goods order month-on-month expected to expand by 0.6%. Thank you everybody for listening, and have a successful trading session.